We're very pleased to be here today to talk about the listed private equity opportunity. We're going to come at this from two angles if we can. The first is whether this is a good time to invest in listed private equity per se, given the strength of the underlying vehicles. And then in the second part, we're going to look at whether the concerns that investors typically have about listed private equity are justified, particularly in the current climate. So let me introduce my panel, first of all, very briefly. So immediately to my left is Sam Armstrong, who's a partner at Barwon Investment Partners in Australia. Next to him is Peter von Lehy, who's a managing director and member of the investment committee at NB Private Equity Partners, which is part of Neuberger Berman. Next to him, Emma Osborne, who's a senior partner and head of the fund investments team at Graphite Capital. And last but by no means least, we're getting our money's worth out of Will Allen, who's returning to join us again. So thanks everyone for joining us. I guess a little context first of all. Obviously, in the aftermath of the crisis, almost every listed private equity vehicle got hammered, frankly. Since that time, the discounts have remained stubbornly high relative to historical averages. But in recent months, as Andrew talked about before, we've seen discounts narrow a little, and we've seen some positive NAV stories. So I guess the question is this just a question of a rising tide lifting all boats in terms of the stock market, or are listed private equity vehicles in a better state now? Sam, do you want to start off with that?
Well, I think the vehicles themselves are obviously in a much better state now than they have been. I think the easy gains, if you like, have been earned. But we still think there's an enormous amount of latent value within these listed private equity vehicles. When we look at valuations on a look-through basis, most funds are valuing their companies around 7.5 times EBITDA, with about 2.5 to 3.5 turns of debt. But when we look at the prices at which new deals are being done, they're being done at about 9.5 times EBITDA, suggesting there's a 30% discount or so to existing private equity portfolios. This is actually validated by the uplifts over carrying value at which we're seeing exits occur. And we looked at a sample of 30 exits by LPEQ members over the last year, and on average they're around 40% uplifts. So we think on existing portfolios, likelihood of very good returns being earned, should the exit markets continue to remain favourable. But as to how the terms on which capital is recycled, I think it's interesting that none of the themes that investors thought might play out, as in banks selling off assets, corporates restructuring because of financial distress, they haven't really played out. So I think the returns that are going to be earned on recycled capital, I think that's less clear. But a lot of embedded value in existing portfolios.
I do think that if you look across the private equity spectrum, one of the best places for value is listed private equity. So in our shop, we have a large business for investing into funds on a primary basis. We do a meaningful amount of secondary activity, co-investments, and direct debt. And if you look across all of those areas, I actually think the area that you can buy good, high-quality private equity assets the least expensively is clearly in the listed private equity space. Now, the question there is, I would say it's a screaming value. The question is just then, will that value ever be realized, right? So the only reason why one should not be going into listed private equity, given that relative valuation, is if you believe that it will never get better. Well, I think that's a fairly heroic assumption, to the negative, because I think when you have high quality assets in these vehicles with stable capital structures, and I do think one of the reasons for that big dip before was I think people were just afraid of everything, but I think also, frankly, the listed private equity sector could have done a better job for managing capital structures of their vehicles. And I think that was one of the issues in the past, but I think that is very much an issue of the past. I think people have gotten it right now. And so I think if you actually look at the underlying value, no better place.
Emma, can you talk a little bit about the health of your underlying portfolio, I guess, both in terms of how it's growing and also balance sheet strength?
Yeah, I think, I would echo what Sam said in terms of the portfolios are in much better shape. And I think underlying trading in portfolios is the key to to NAV growth. And certainly in our portfolio over the last year, we saw EBITDA growth of 13%, which in the current environment is a pretty good result. And I guess one thing I might slightly disagree with Sam about is that so the new investment side, I think we're seeing really good new deals going into the portfolio. I think as capital is starting to come out of the system, so we're seeing some managers failing to raise funds or funds being raised that are smaller than last time. I think the new deals completed in the next few years should be done in a slightly more benign competitive environment than there were through the last fund cycle. So I think we're positive on both the portfolio and the new deal side of the kind of current opportunity set.
Will, can I bring you in here on, I guess, on a couple of things? You talked about the amount of refinancing that's been done in the last year or so. Presumably that's helped to kind of de-risk portfolios to some extent. And then I guess the other thing is, when we're talking about new deals, do you think deals are available at decent pricing at the moment? What's your take on that?
I mean, on the refinancing point, I mean, I didn't want to mislead anyone when I was up there, but the truth is, at the moment, the sort of the debt markets aren't being truly tested because there isn't an awful lot of deal flow, which means that the active participants are pretty much prepared to do almost anything you ask them. So if you want to do a dividend recap, you can. If you want to return all of your initial invested capital, you can. And we're seeing a lot of that. So a lot of the work that we're doing at the moment is focused on that, and of course that's giving funds the ability to hold on to assets for longer. If they're not achieving the right interest or getting to the right price point when they come to sell them. I mean, in some ways it's a bit frustrating because we need, from my perspective, I'd like to see more M&A, but if you've got banks prepared to refinance, then in a way you're stopping that M&A from happening because you're giving funds an alternative.
Can we just talk a bit about the different types of model that investors can access via listed private equity? And there's obviously the direct approach, the fund-of-fund approach. What are the kind of relative merits and demerits of each in the current market, do you think, Sam?
Well, I think fund of funds, and I think the listed fund of funds sector is evolving in a very interesting way, where the listed fund of funds are sort of increasingly becoming more differentiated and offering interesting strategies that might be focused on a geographic basis or a deal stage focus, whether it be secondaries or whatever. And I think they offer perhaps individual investors a kind of a one-stop shop, diversified portfolio, or as I say, sector-specific strategy. And as they've matured, and now as a sort of sector moving much more into a sort of cash generation phase, I really think they're going to capture more attention more broadly. But then I think the direct investing funds continue to offer perhaps institutional investors and fund managers like ourselves, an interesting way to build a private equity program across different deal stages, different industry sectors.
Is your view typically that the direct investing approach offers potentially higher returns but also greater risk? Do you look at it like that?
Well, I think by definition the fund of funds are more diverse and so should be lower risk.
But in absolute terms, the direct ones could produce higher returns?
Well, you would hope so.
Yeah.
It's interesting. It's an area that we've been focusing a lot of attention on. Our vehicle has always had a combination of fund investments on a primary basis, secondaries, and co-investments, and as well as some private debt. We've been, as well known, over the last few years, we've been shifting our strategy from doing primary investments as a majority of our portfolio to really being focused on direct equity co-investments and direct private debt. Sam's exactly right. The benefit of the fund of funds is that having that broad-based exposure to the private equity asset class, the lower risk from the diversity. The negative on the fund of funds, though, is because some of them are so diverse that it's all but impossible for someone to value the assets. They're oftentimes intransparent. And then the other issue I think that the fund of funds faced in the closed-end fund form that I think most people have underestimated the risks on is the overcommitment. If you run a pure primary strategy, the amount of overcommitment that you have to do is very significant if on average you want to be fully invested. And so that means you have to be very careful with how you manage your capital structure. And there's capital structure risk of overcommitment for a fund of funds. So our approach on that is to try to do the best of both worlds. What we're doing then is having, because we are lucky enough to have a very strong equity co-investment program and direct private debt program, what we're doing is giving the benefits of a fund of funds by actually having that broad diversity by underlying investment and by the lead manager, but doing that on a direct basis. So making sure you're cutting out a layer of fees, which is, of course, hopefully should be helpful for net returns for investors, as well as reducing the overcommitment risk.
I mean, your strategy obviously has elements of both. When you talk to investors about it, what are they saying to you?
Yeah, I think that we also combine both funds and directs, but our business model is slightly different from NB in that we are actually a fund of funds manager sitting within a direct buyout house. So I think we like to think we combine the best of both worlds as well in terms of, yes, you have the diversity of the fund of funds, but you also have sufficient concentration for individual winners to still make a difference. And most of the largest holdings in our portfolio are in companies that we control directly ourselves as the lead manager, and we like that dynamic. So I think it's a subtly different model to the co-investment model. So I think, clearly some investors are always going to prefer direct and some are going to prefer fund of funds, but I think there are subtle nuances in the middle with this sort of hybrid model.
Okay, perhaps we can move on and talk about some typical investor concerns, starting with the nasty D word, discounts. I guess most people in listed private equity tend to tell us that people put too much focus on discounts generally. Do you think that's true? Are discounts still too high? Does pricing look cheap at the moment?
Well, I think ultimately, and Ian Armitage mentioned this last night, the problem with discounts mean it's ultimately very hard for funds to raise new equity, then that in itself can create a problem of scale, that the industry struggles to scale up to be of sufficient size to give investors the liquidity they need. But I don't think discounts in and of themselves are a problem really. They're, in one way they're an opportunity for investors to buy assets cheaply. I think the real problem is it just makes it difficult for funds to raise new equity, and the market can become, particularly when it's most opportune to make new investments, it can struggle to access new cash. But I think discounts, on the one hand, we consider them an opportunity.
PC, you've obviously got good visibility on the secondaries market, and Andrew talked about the differential in pricing there.
Yeah, it's interesting because Andrew's graph earlier of how they used to track fairly similarly, and then in the last couple of years, actually, the secondary market has gotten higher priced and the listed space is not quite caught up. It's interesting though, because everyone uses discount as a shorthand, but our view, like even when our secondary team is analyzing a secondary, the discount is actually the outcome. It's not the base of what we do. We don't say, okay, we want to buy this for a 10% discount or a 20% discount. What we say is, okay, what do we think the cash flows are that we will receive in the future? Discount that back at an appropriate rate, and that gives us the price we need to pay today. And that oftentimes results in a meaningful discount, but that doesn't, but that's not the driver. And so I think personally, I think that's how investors should look at all of the listed private equity stocks is, what do you think the value of this stock will be in the future? What are the value of the assets in the future? And then come up with the appropriate rate, and whether that's a discount, fine. If not, but I do think listed private equity is the best. If you actually believe in the quality of the underlying assets, which actually, I think is incredibly high, I think that it does end up being a screaming buy at these price levels.
I think Peter is exactly right on that. And if we look back at the secondaries, secondary LP investments that we've made some of the best returns from the ones that we paid little or no discount, and there isn't a perfect correlation. But I do think, so we very much are of the view that you should buy listed private equity for the NAV story, and then if you get a bit of a boost from the discount narrowing, then that's a nice extra. And we're still way off our long-term average, so that would suggest that there's more upside than downside in the current discounts.
I guess one of the things that seems to have done some groups good in terms of discounts is having an explicit policy of returning cash to shareholders. I guess there are different takes on this. There are various vehicles who seem to be looking at doing this in different types of ways. I guess the question is, should listed private equity be doing more to give cash back to shareholders, do you think?
Well, I just think a distribution policy and giving some cash back by way of a dividend, is a way for investors to capture the discount, and particularly for longer term holders. So I personally think it's a good idea. I think many funds have moved and articulated distribution policies, whether it be to distribute 50% or whatever of their net realised gains, and I personally think that's very positive. I guess the only downside is, if you distribute cash by way of dividends or capital buybacks or whatever, you're ultimately decreasing the size of your vehicle. So I suppose as long as you don't get to the size where you're distributing so much cash that the vehicle loses scale, otherwise I think it's ultimately very positive to have some kind of distribution policy.
Yeah, I would say we take a slightly different view. We do pay a dividend as required by the investment trust rules, but we think that investors buy private equity for capital growth, not yield. And Peter's right, there is currently no evidence that investors are valuing the yield, because there's no difference, certainly in the fund-of-fund space, between the vehicles that have announced higher return of capital and those like us that have just stuck to the kind of normal yield. And so I think our view is that managing cash and commitments and portfolios is complicated enough in a fund-of-fund structure, and layering on an obligation to return a certain amount of cash every year to shareholders would inevitably end up making us manage the portfolio differently and sacrificing upside. And so,
And I'd agree with that.
Because our portfolio generates virtually no running yield, and therefore it's quite different if you've got a debt portfolio, clearly. But we think our vehicle is a testament to the power of compounding. We've generated 26 times the original capital over the life of the vehicle, and so that's what we would like to do going forward.
I'm conscious of time, so perhaps one last question if we can. Will, can I bring you in here? Maybe one of the reasons why people sometimes don't invest in listed private equity is because they see it as an inherently risky proposition because of the leverage and that kind of thing. Do you think that's fair and just in the current market?
I mean, I think leverage did get too high pre-Lehman. I mean, there's a deal that I'm looking at at the moment that was put through a dividend recap in 2007. It's effectively a boilers and radiators business, right? So very much linked to the economy, and it was recapped at 5.7 times EBITDA, and that's probably what it's worth. It's probably what it's worth now. So I think, absolutely, pre-Lehman debt got out of control, but really since then I think people have learned a lot of lessons. And you saw the stats I put up earlier. Average leverage is, on a senior debt basis, a full turn lower than where it was in 2007, and through total leverage, it's almost a turn and a half lower. So I would say that leverage, that level of leverage is pointing to less risk. Also, I think a lot of banks, banks don't like having to take over companies. It's the last thing they want to do. I think, given the number of insolvencies that we saw, I mean, it wasn't a huge number, but we did see quite a few. and the way in which the banks approach those. I think you can build in features now into your financings, and the banks are willing to give you those features that give you every opportunity to sort of avoid going into a debt-led problem. So I think a combination of lower leverage and more borrower-friendly terms is really reducing the risk profile.
Marie, you a risky proposition?
No, we don't think that we are. I think one of the problems is that private equity covers such a wide range of strategies, and I think it's probably incumbent on us as managers to communicate well where we sit on the risk spectrum. So clearly something like venture capital is quite high risk because you're expecting that you'll lose a relatively high number of investments, but you're trying to look for the big winners like the Facebooks. We don't do any venture capital. All we do is invest in mature, profitable companies where the valuations can be measured by multiples of profits and cash flows, not future revenues or subscribers. And we do this by investing in established managers with proven track records in mature private equity markets. So the underlying investments are inherently relatively low risk. And then you layer onto that a conservative approach to balance sheet management and portfolio construction. And what you end up with is something that's actually fairly low risk.
I would agree with both those sets of comments. I think just the only thing I would add would be to say, take for example, with the U.S. numbers, if private equity is buying into companies today at multiples of EBITDA in the 8s, the public markets are at 11 times EBITDA. You can buy into private equity deals in the 8s, and you can buy into those through vehicles like ours that are trading at a discount to net asset value. On a relative value basis versus everything else you can do in the public equities markets, you're buying in so much cheaper. I think that gives you a fairly wide cushion relative to your other opportunities. So I think that's just an additional factor.
Sam, I guess you would argue the risk-adjusted returns are worth the investment?
Look, absolutely. And I think the Private Equity Council in Washington wrote an interesting paper, I think it was about 18 months ago, showing that the rate of default and rate of corporate failure amongst private equity-backed companies was actually lower than listed companies.
I don't know if we have time for a question.
I've got a very quick one, if I may. Sam, you're an investor into listed private equity vehicles. If you were to look at an index of listed private equity, LPEQ Europe, I mean, clearly everyone's looking at good returns, which is great, but some might be put off by the volatility that you might have seen over the last 10 years or so on. I mean, how do you approach that? Should people be put off by volatility in this sector?
Well, I think if you look at a lot of the cap-weighted indices of listed private equity, you might be put off by the volatility because they do show a high level of volatility. But I think most of those cap-weighted indexes become very skewed towards whatever particular sector is the sector of the day. So mega buyouts until the credit crisis, or venture capital until the tech wreck. But I think if you strip out and look at adjust for that, and you look at a more sensibly balanced portfolio, it doesn't demonstrate quite the same volatility. However, I think unfortunately even adjusting for all those things, the sector would be embraced by a lot more investors if it weren't quite so volatile. And I think as the sector grows in depth, which it is, you might see a lot of the volatility subside and the opportunity to diversify more effectively improve.
Thank you. Thanks.